Your Airbnb income isn't always what a lender uses to qualify you for on a DSCR loan. Welcome to Mortgage Tips and Bacon Bits. I'm Sean Segaloff. So I appreciate you watching. I'd also appreciate you clicking like and subscribe. It really does mean a lot to me. So when it comes to a DSCR loan on a short-term rental, there's a couple things we got to keep in mind. The first one is the lenders are looking at actual supportable. Sorry, I couldn't remember the word supportable. Forgive me. This is how you know we're not editing this and using AI. You see all my mistakes. Supportable income, not your best projections. So they want to make sure that the income being used for the ratios is something that's verifiable, whether it's a long-term rental appraisal or whether it's documented short-term rental income or leases. There's got to be a way to back up the numbers. It's not just our best guess or our best estimate. That's how people get in trouble, and that's how lenders honestly aren't going to lend because they're not going to take that amount of risk. You know, when it comes to the rental appraisal, you know, you're doing a short-term rental, but a lot of lenders are still going to look at the long-term rental. You know, there's a safety net for them there because short-term rentals can be very much like this depending on season, depending on the area, depending on something happens. Where a long-term rental, you know, that's a tenant. That's somebody that's going to be there for a year, maybe longer. So most lenders will look at the long-term, even if it's a short-term rental. Now, keep in mind, I do have lenders that will look at the short-term rental. So you do have options. You want to make sure, though, when you're looking at the rental income, you know, the appraiser is going to do their appraisal of the rent schedule. So I will say this, in some areas that are very, very heavy on short-term rentals, the appraiser will actually put in the short-term rental value because they know the area, they know the property. You'll see this frequently, like in the mountains in Tennessee, you know, Pigeon Forge, Sevierville. I always mispronounce that one, but it's a beautiful area, by the way. If you ever go there, go down to Paula Dean's restaurant. As a fat guy, I highly recommend it. Fried chicken butter cake's amazing. So back to the rental info. So they're going to put what their rental value is. And again, like I said, you know, a lot of times they're going to be looking at long-term rental. That's what the lender's going to look at. But like I said, if the appraiser knows it's a short-term market, I have seen where appraisers will put the short-term rental income. So this is Mortgage Tips and Bacon Bits. So got to drop some bacon bits on you. So when you go to a restaurant, how are you ordering your bacon? Are you one of those people that say, I want it crispy, I want it burnt? I get a friend of mine that grew up with a long-term friend, known him for, God, too many years. Yeah, I'm getting old there, if not old already. And when he orders bacon, he gets it crispy, and then he sits there and he breaks it, and he pulls out the meat portion and doesn't eat the fat portion. And I just kind of look at him like he's crazy. And I'm like, well, then why order bacon? Order ham. So that's just kind of my thought there. Anyways, back to mortgages. Let's see. Moving my my bullet points so I can see them better. You know you're getting old when you have to wear cheaters when you're filming a video instead of going, hey, look at me. Anyways, so seasonal volatility and vacancy. I can say that. You got to remember when you're looking at short-term rentals in certain areas, you're going to have spikes. So when you're deciding to purchase a property and you're looking at, let me see, you know, what it rents for, you want to make sure you're taking that season volatility into account. You don't want to just base it off of peak season. It's not going to be peak season all year round for most places, you know, especially let's say a property that's up near a ski resort. Your peak season is going to be the winter during skiing. You know, during the off season, you may still have people, but it may not be as busy. Someplace where the weather's warmer. Peak season might be during the winter with, you know, snowbirds coming there. You know, those are things you got to take into account. You want to make sure you're looking at the full year projections, the ups and downs and averaging it out, because that's what the appraiser's going to do and that's what the lender's looking at. But most importantly, that's what you need to look at for your budget so you don't run into a situation where you go, oh my God, we're having a bad month. We can't afford it because we didn't factor this in. So insurance. When it comes to insurance, some insurance companies are going to charge you more on investment property if it's short-term rental. Now, I'm not telling you to go and say it's a long-term rental and get it as a short-term because, you know, that's fraud. So please don't do that, and you're not protected that way. But you got to understand there's more risk to a short-term renter than a long-term renter. There's more risk of damage. There's more risk of penalties, whether penalties, slip and falls, accidents. There's a lot more risk when the insurance company knows it's a short-term rental. So you want to make sure when you're getting insurance quote, you're telling that insurance agent or insurance broker, hey, this is going to be a short-term rental. Make sure you insure it as that. No different than if you have a car and you're driving for a Uber or Lyft and you want to make sure you have the correct coverage. You need that correct coverage when it comes to the rentals. Yeah. The safe approach, honestly, when you're looking at your short-term rentals and you're trying to decide what to buy and doing it is look at the long-term rental value. Now, maybe best case scenario that you have a lender that uses the short-term value. That's great. You know what? Your ratio is going to be better, which means your terms are going to be better. But I'd rather have you in kind of a worst case situation so there's no surprises and make sure you're comfortable with that. Because you want to make sure, again, that you're covering your goals, whether your goals is for cash flow every month or whether your goals is just covering your expenses or almost covering your expenses because you're going off the appreciation. Ideally, we're always looking for a 1.0 to 1.24 ratio or, better is great. But there are lenders that go less. There's lenders that go down to 0. You really don't want 0 because that means there's no money coming in at all, so it doesn't really make sense. But let's just say, it's a 0.7, so you're coming out of pocket every month for a couple $100, but most of the mortgages and expenses are being paid by the property, and you're gaining that appreciation in those appreciation markets. So that's stuff you want to keep in mind. So if you found this information useful, if you have any other questions, you got my calendar link down there. Happy to have a conversation with you. But also, please share this with someone that would find the information useful. And don't forget to hit subscribe button. I really appreciate it because mortgages, they don't need to be complicated. They just need to be explained clearly.